Only 3% of the global money supply is actual physical currency. The remaining 97% is digital, generated by banks. Through fractional reserve lending, banks create new digits out of thin air, expanding the money supply like a balloon under intense pressure. Decoupling money from physical assets creates severe systemic fragility. In 2008, the pressure of that debt exceeded the structure holding it, and the balloon burst. Instead of anchoring the economy back to reality, the financial industry accelerated the expansion. They began stacking financial contracts on top of other financial contracts, derivatives, pushing global leverage to astronomical levels. If stacked as physical paper, the total dollar value of global derivatives would reach past the atmosphere and rotate around the sun dozens of times. The mechanical flaw driving this inflation is treating money itself as a product. The conventional system buys, sells, and rents money to multiply it. Islamic finance offers a direct macroeconomic alternative by rejecting the commodification of money. Under Islamic law, money is strictly a medium of exchange, a manufactured tool to facilitate trade, not an asset capable of generating more of itself. Preventing recurring global economic crashes requires replacing a debt-backed financial structure with a direct asset-backed one. For Muslims, the prohibition of earning interest is a non-negotiable theological axiom rooted in the covenant of the Kalima, a complete submission to divine law. Demanding interest, known as Riba, is prohibited absolutely. The texts elevate it above nearly all other sins, treating it as a war against divine logic. This rejection of interest is not historically exclusive to Islam. For centuries, Judeo-Christian traditions and European moral frameworks also strictly condemned interest-based lending. The turning point arrived with the Industrial Revolution. Massive new factories required rapid capital injections, and the demand for financing outpaced traditional moral restrictions. To solve this tension, Protestant leader John Calvin introduced a philosophical workaround designed to service the new industrial economy. Calvin engineered a new dichotomy. He defined usury strictly as maliciously exploiting the poor. He categorized interest, however, as a tool for wealthy merchants borrowing for their businesses. The entire modern global economy operates on Calvin's theological loophole, decoupling macroeconomic risk from physical and moral reality. Islamic jurisprudence maintains an unbroken consensus across all major schools of thought, rejecting Calvin's split between usury and interest. The rule is absolute. In any loan, demanding a guaranteed financial surplus over the principal amount is riba, regardless of the borrower's identity. Calvin's model relies on a subjective, unmeasurable line. There is no objective standard a lender can use to determine exactly when a borrower transitions from poor to wealthy in complex institutional trade. Modern banking defenders argue that corporate loans fuel enterprise and economic growth, and therefore shouldn't be penalized as usury. But the validity of a transaction cannot depend on the buyer's net worth or what they plan to do with the funds. A transaction must be judged by its mechanical structure. Charging money for money is invalid by design. Treating interest as distinct from usury is a false dichotomy. It justifies the perpetual exploitation of capital and inevitably rebuilds the same fragile debt-based balloon. If charging interest is prohibited, the central question is how capital grows and funds major enterprise. Look at the conventional banking cycle. Money is exchanged for money plus interest. $100 becomes $110, then $120. This creates a mathematical loop decoupled from physical reality. The Islamic alternative requires a different mechanism. Capital only grows when money is transacted against a tangible commodity or a real service. To earn a financial return, the provider of capital must take on actual physical liability. This is the requirement of shared risk. We see this mechanism clearly in ijada, the Islamic equivalent of leasing. The critical mechanical rule of ijada is that the financier, the lessor, must retain the physical risk of ownership. If the leased asset is destroyed, the rent immediately ceases. In a conventional lease, the debt survives the asset, and the borrower must keep paying. This single requirement of shared risk forces the financial sector to anchor itself strictly to the production and maintenance of real, tangible goods. Scaled up to the macroeconomic level, this rule structurally chokes off the creation of synthetic derivatives. You cannot stack financial papers if every contract requires physical liability. By mathematically restricting the money supply to the size of the physical economy, financial growth remains strictly bound to the actual production of tangible wealth. Skeptics often dismiss this as a utopian theory, but it has seen massive, real-world institutional deployment since the 1970s, driven by legal scholars like Mufti Taqi Usmani. This chart visualizes the current empirical reality. As the line graph shows, Islamic assets are growing at a rate greater than 15% annually across 90 countries, vastly outpacing conventional finance. This expansion extends well beyond Muslim-majority nations. Asset-backed home financing institutions are now operating across the UK, Europe, and the United States. Conventional institutions often push back against this model, recognizing that strict physical asset requirements threaten the hypervelocity of capitalist lending. There is also an internal challenge. Many Muslims attempt to seek out legalistic workarounds to participate in the conventional debt system. Some rely on an outdated misconception regarding Dar al-Harb, the idea that participating in interest is permissible for Muslims living in non-Muslim lands. Modern consensus rejects these geographic loopholes. A forbidden transaction does not become permissible simply because you cross a border. Compromising on the absolute prohibition of riba, even for a single mortgage, degrades the entire macroeconomic firewall. The rigor of these rules provides the structural integrity necessary for building parallel, crash-resistant global institutions. True systemic stability requires treating money not as an endpoint to be hoarded, but as a medium strictly bound to human productivity and tangible reality.